Since mortgage rates are topping like 7%, some buyers are seeking alternative methods to getting a lower rate to help lower their mortgage payment. Now, we've already talked about buying down your mortgage rate with discount points, as well as other programs that your lender might offer, like a 2-for-1 temporary buy down. So in today's video, we will talk about an ARM, or an adjustable mortgage rate, and it is exactly what it sounds like, a mortgage rate that adjusts or varies. Now, unlike a fixed mortgage rate where your rate is set for the entire life of the loan, an ARM fluctuates during the term of your loan. So it can be low or high depending on economic conditions. So here's the thing with ARM mortgages. The rate can be fixed for a certain time period, then fluctuate once that time period expires. So for example, you can get a fixed rate for 5, 7, or 10 years, and then once that fixed time period is up, your rate will adjust accordingly. So let's say you get a 5-1 30-year mortgage, then your mortgage rate will be fixed for the first 5 years and then adjust once per year for the remaining 25 years. Now, the second number after the slash lets you know how often the rate will adjust per year. Again, the adjustment can be either up or down depending on economic conditions. There are different types of ARM mortgages. Hybrid, which is the type of loan we just discussed, a 5-1 or 7-1. Interest only, where you make interest only payments for a set amount of years, then thereafter you start paying down the principal. And then there's the payment option ARM mortgage, which gives you a few options to pay back the loan. One of the benefits of taking out an ARM mortgage is that your interest rate is typically lower than the current rate for your fixed time period. Now, just this past week, the interest rates for a 5-1 ARM mortgage was about 5.5%. Now, another benefit is payment caps, which limits how much your lender can increase the rate, as well as how many times a lender can bump up the rate. So the downside to an ARM mortgage is that they are riskier than a fixed rate mortgage. There is a high chance that the rate will increase once your fixed time period is up, which will lead to a higher mortgage payment. Also, I know that I covered a few types of ARM mortgages, but there are many different types or many different ways to structure them, and this can get complicated. Now, if you know that you will not live in your home for a long period of time, then an ARM mortgage could work in your favor. Also, if you know that you'll be rolling in more dough in the upcoming years, or are really financially set, you could explore an ARM. But whatever you choose to do, please do your research and make sure that your decision fits your financial situation. Also, be sure to fully understand the conditions of your loan. So before the 2008 crash, a lot of borrowers lost their home due to an ARM mortgage payment. So what happened was they couldn't keep up with the payments once that payment increased. So please choose wisely. I'm Renee, the Realtor. Thanks for tuning in, and we'll see you next time.